So the first thing I want to talk about on my list is this is the overarching thing. If you're concerned about diminished return opportunity, or if you're thinking long term, can I use the data to help me do better than the market with my long term portfolio? Look, I think both of those things are true, and we're continually studying the data, and I think it's crucial. I mean, the data just keep coming back to this. Um, I have this utility that I had one of our developers create, and it's not finished. When it is, then we're 2, 3 steps from adding it here to the profiler, so that you can use it and draw your own conclusions. But it lets me put in a bunch of criteria for entries and exits, and then overlay a risk management strategy. What happens if you don't use the risk management strategy? How does the portfolio perform? Poorly. Well, it performs like the market, and you give back a lot of gains. But with a risk management overlay that says, well, just sit out during these periods and then come back, sit out in cash, come back, the returns can be very remarkable. Now it's a model, and models don't necessarily conform to reality, but it's using the same data. We're just using the momentum data, the low volatility data to do that. So this is what I want to point out. Looking at the broad market, could we know? Well, I point out all the time that when the market goes above, just generally, I mean, you could say 6.4, but above the red line. And if you're new, the red and green lines. By the way, I clicked what's called broad market sentiment, so it's taking the data for the underlying 500 stocks comprising the S&P 500 and averaging the demand read, so market structure sentiment. It's an algorithm normalized to a 10-point scale that meters buying and selling by measuring trade executions. That's what it's doing. And we do it demographically. We say there are 4 big reasons that money buys and sells stuff. Story, it's the smallest thing now. Characteristics, it's the biggest investment behavior. So that means, is it a large cap? Is it in the tech sector? Is it growth or value? Does it have quality characteristics? Is it a volatile or low volatility stock? That's what the money consumes. Price, biggest motivation in the market is the pursuit of price. And then derivatives. And you can run a model that combines those things and how they contribute to overall volume, and see how supply and demand wax and wane. That's what this is. The green part of the graph is demand. Then you have the closing price of SPY, which has done really well, and then underneath supply is short volume, the data set associated with the modified uptick rule. It's the supply chain of the market. So when you have rising demand and falling supply, prices do well. When supply rises and demand wanes, particularly when it comes back down, prices tend to falter. And you say, well, they jump right back up. Yeah, but you wouldn't have missed any of that. If you just wait for the uptick, here it is. The price came right back to meet you, and off you go, and you're above 6, and we really didn't wane at all here. Then here, start to wane about here. There was the point probably that you should leave, because statistically, the market doesn't do better after that. And sure enough, the level of the market is now below where it was then. So it's just something you could use. If you can avoid the losses that others incur, you're going to do better. Notice that supply rose too. I think it's a very good way to modulate risk, and you could do it with a larger portfolio. If looking at the data, that you have the strong demand and falling supply, you want to be in growth stocks, momentum portfolio stocks, maybe even a leveraged SPY instrument. When those things change, adjust accordingly. Okay, now we want to reduce our exposure to the market, and to do those things, that you don't have to sit and watch all the time. You just wait until demand and supply broadly change. It's something that we've got edge users because I get emails from them, who are doing that pretty successfully with larger portfolios, saying, I'm principally using the data to help me increase or decrease exposure to the equity market. Again, it doesn't work perfectly, but it is a very good way to go about it. Now, back to this, would we have known? If you go back to when the market went above 6.0 demand, it was here on July 11th, and really it hasn't been below it since. And SPY was at 442 then. And yeah, that's probably an apt response to that. And if you look at where the market is now, it's not far off of that. I don't know where it's traded. It's up and down today, but I think it was at SPY was at 449. It was 442 back here. Could it go back below that? Could. I don't know what it's going to do. My point is that there is not a material difference in performance after that point. There is in between, but if you're just buying and holding, then you got nothing. You have your money exposed to risk, and you got no reward for it, no alpha, a risk-adjusted return. And so, if you're particularly risk averse, you could get some pro rata portion of 4 or 5% in cash if you don't want that risk. It's just a very nice way to go about it. Now, that's part one. I'll pause there for any observations, thoughts, reflections on this, and feel free. Okay, and Alex, I see your question. And just feel free to weigh in. Let's see. Pam, I'll address yours, and then Alex, I'll address yours. Do you speak to the difference between the broad sentiment and the price in one of your videos? Well, I hope so. I think so. But they don't. There's not a perfect correlation. It's not meant to be a perfect correlation, and there is a pretty high correlation between them. It's not going to be, it's not going to be perfect because it's meant to give us some warning. And so if there's warning, there's going to be a correlation breakdown. Sometimes it's almost perfectly correlated, like here. Sometimes it's not correlated here. What happens? I don't know precisely. I can tell you there are supply and demand differences. People use derivatives. There could be a slowdown in money being committed to 401ks, and then people pick up again. All of those things can cause fluctuations that a model is not going to perfectly account for. So that will create some separation in prices. But if one were to, if you go back and model the date, which we do, that's why I feel comfortable asserting it. When we model the data, the probability of returns after 6.0 diminishes to effectively zero in a model. There are exceptions to that. In strong momentum markets, there will be an exception. Alex, let me get to yours. I think you said why 6.0? Well, it's so if one considers that it's the same measure, but there are 500 components, you say 4 and 6 is a pretty narrow range. Well, really, the market does that. The reason we use 6 is because it's where the math tells us the ceiling is hit. Why is that the case? Well, it's a 10-point model. 500 things are going to push the average toward 5. That's what's going to happen. Then if you think about how the stock market works, trades have to occur between the best bid and offer. And I repeat myself because it's sometimes helpful to be repetitious. Stocks have to trade between the best bid to buy and offer to sell. And that pushes things toward an average. On a scale like we've normalized here, the average is 5. And for the stock market to rise, it must average better than 5, which it does. Over the long run, the stock market averages about 5.5. When you get above 6, what is happening? Well, you've got more, too much money chasing the same goods. And what tends to happen is that the money in models will be overweight and will reweight. I cannot tell you how often we see that in the patterns. I can look across the S&P 500 right now and see that the last 2 times since June 1st that the market has had little downticks, it's been because indexes reweighted. It's occurring now. I said I was concerned about the NASDAQ 100 rebalance, that it could tip the market over. And I'm not withdrawing that conclusion yet, because the volume in the big Magnificent Seven, they like to call them, has come down 30%. Have you seen that? Huge drop in the volume in those stocks. And they're crucial to the market. And if I look at the patterns of behavior in the market, it's indexes and ETFs, not knowing, well, what do we buy? And if that slows down, then you throw in a Fitch, U.S. government downgrade. I'm not, is that it's just adds to the mix because there are risk management things that happen. But it could. There isn't any place for the money to go. How that relates to 4 and 6, money and indexes has to rebalance. If I'm overweight tech, I'm going to have to reweight. If I'm underweight energy, I'm going to have to reweight. If I'm overweight equities because they've gone up 10%, now my model's off and I have to reduce my exposure to equities because I'm out of whack with my fixed income balance or whatever. That stuff's continuously happening, and not enough credit is given to that. It's more than half of all stocks are owned by passives. It's really, in my mind, closer to 70% if you include closet indexers. So 70% of the money is returning to a mean. Well, that's effectively what we're measuring with demand. The money returns to a mean. Ergo, if we're down at 4, below 4, somebody's going to have to reweight, and the market's going to go up. We get above 6, it's going to have to get reweighted. And I don't know exactly where that's going to happen, but we know it's coming. Statistically, it happens within a month. And if you looked at the data, going back with that in mind, statistically, we got here on July 11th. Well, it's August 3rd. It's not exactly perfect, but we are just about back there. And maybe we won't be. If there is more demand than supply, and the equation isn't bad. I mean, if you look at this period, which is I think it's roughly a 90-day trading period. I think that's the default. That this demand and supply are separated. The supply trend is down, and the demand trend certainly has been better than its average, better than 5. I don't run the average on that. Maybe it's 5.4, 5.3. Well, that will create a rising market, but we're due for a rebalance, and you can see that coming. And I think that can be very helpful for long-term portfolios. If you say, well, I can't trade as actively as I'd like because my broker won't let me, here's what you can do. Use leverage when you have opportunity. When the market has reached a peak, reduce your exposure, maybe even short the market, as I did. I shorted the market because I went, well, it's probably gonna decline some. I sold my hedge yesterday. I did. I took the gains in the hedge. I can always reset it. But it was additive to my performance, not terribly material. But that's a good long-term look at things. One more piece of that puzzle is how to use portfolios for that purpose. You could, you say mathematically, does this work? The low volatility portfolio consistently does better than the market. We've run the data on this. If you just own the low volatility portfolio, it does better when the market is flat or declining. A lot of those stocks are dividend payers too. So if you wanted to, you could do that. Right now, there aren't very many in it. It's telling us we're at this juncture again where both momentum and low volatility aren't awesome. But it's a way to think about it. And you could create portfolios to do your own thing if you're comfortable. I just pretty much use these data. I do run a little bit different mix of data with these Edge Momentum ETF, Edge Value ETF. They're just experimental data sets that we test because could we create some IP for an ETF? Well, sure. And we think about that opportunity. I think about, well, can we leverage our IP and produce some additional revenue off it? Well, yeah, you could do that. This is just looking for a slightly broader basket than the low volatility portfolio, but it's saying, demand's at 5, they're liquid stocks, so $3,000, volume over 500,000, a lot of time at 5 out of the last 30 days. I want to find stocks that have real value characteristics. and short volume supply trend in the last 5 days down, so that there are things that have a tendency to produce gains. And you could reweight that. You could run it, and every week you go reweight it, and remove the things that no longer have those characteristics. And in a challenging market, that would produce reliable returns. In a growth market, it doesn't. Money shifts away from value and goes somewhere else. So a great way to see this is, I've got KHC up here. I just want to illustrate this. That if you look at Kraft Heinz, which is a great value stock, and you run it year to date, you can see where the money left to go chase growth. It happened back in January when, tech stocks boomed. Our momentum portfolio in that, I ran data, it was up almost 14% from January 3rd to about February 12th. And look, they have insufficient supply or demand, because that money yanked out of value and went and chased growth. And it did it again here, right at May expirations. This is when we saw that explosion of momentum opportunities in the momentum portfolio, jumped up to like 30. And look at what happened to Kraft Heinz during that period of time. Insufficient demand. Its demand is not, this is what a value stock does. It stays at 5. And if there is, and if, supply declines, then the price will rise, but not a lot. It's going to give you some modest return. We're seeing a return to value now. But isn't that interesting? You could see that. Okay, money is, what is chasing NVIDIA? Well, part of it was money came out of low volatility value portfolios and went and chased growth. And we got to July, and that has begun to change. I think everybody was overweight growth. That's what it can be. My point is, there are ways you could use the data to do longer term things. And it's supply and demand are pretty simple ways to think about that. Okay, let me get, anything I need to, Brian, you got it covered? Am I missing anything? Okay. You veterans, any comments, observations, or experiences that you want to share before I get to short term? No?
Hey, Tim, one question from Sam that just came in.
Okay, are trade signals valid pre-market for stocks that have fallen 50% of their volatility? Boy, it's a good question, and it does raise an essential thing. Pre-market rules are different. I'm very careful. I'll even give you an example, because I wrote one down to share with you about my own experience yesterday and today, where it cost me, and not much. I missed out because of how I had put my brackets in, but they're not as valid. There's a reason. Pre-market, what is occurring outside of normal market hours that is not subject to regulation, national market system rules. Things do not have to trade between the best bid to buy and offer to sell. All of the trading is occurring in broker-operated pools or electronic communications networks. That stuff is, it's, the show Billions, the HBO series Billions, which is predicated on Steve Cohen, Point 72. The SAC Capital was the predecessor, was routinely a shareholder of mine when I was an IR guy running telecom IR. And I talk to those analysts all the time. They're very leveraged, and they use outside market hours derivatives and prime brokers so that they can be ahead of the market. That's what they do. So it's risky, Sam. To trust that means we could get caught out, because stuff is occurring that you can't count on. I prefer, and I don't always do it. I don't always do this, so I will qualify. But in the first 45 minutes of trading, that is machines. That is machines trying to figure out what are the imbalances, because they're all trying to peg where the reference prices at the end of the day are going to be. Sometimes it can work to your advantage, and sometimes it will hurt you. When we know there is momentum in the market, I think you can be early in the market, because machines are going to run the prices. So if there are 30 in the momentum portfolio, and you got one stock that hasn't moved, like half the momentum portfolio is already up 1% and one isn't, the likelihood that you can produce a 3 or 4% return on that is very, very mathematically high. The flip side of that, Sam, which is what you're talking about, and let's look at an example. I mean, is buying half the volatility. So if we look at, let's take, maybe Oracle. Oracle doesn't report until September, so that's not an issue. That's good news. So if we go, you just pull up a browser. And by the way, the data on earnings is ubiquitous. Even at Google, they'll tell you, like, reporting results today. So if you look at Oracle down 90 basis points today, more than half of its volatility. So you wouldn't know that right out of the gate, right? Because in that first 45 minutes, maybe even a little longer, machines are doing stuff. I don't trust it. Sometimes, again, in this environment, falling demand, supply not great, I'm not going to do much in the early hours typically. I want to wait to see that stuff's sort of out of the way. And now, could you buy that and have a pretty good chance of a return? The risk is tomorrow's Friday. There's a jobs report. It would be great if it were, Wednesday, because now you got 2 days and you probably have a very, very high probability of at least a 90 basis point return in Oracle. But pre-market, I think it's risky. Now, you veterans, if you want to share experiences and say, no, I think it's fine, feel free to counter me. I'm still going to do, I still do this. I'm going to look at the close. I look at the closing price. If we go over to low volatility, I'm going to look at, Oracle's in here. So closed yesterday at 115.71. So if it's down 80 basis points, I'm feeling pretty good. Now there are things that are really volatile, like what's it trading? It escapes me at the moment. That 10% intraday volatility, and it was up 5% and down 5%. Well, there's your 10%. It was down 5%. Could it go down another 5%? Well, good, because that's its range. But I'd feel pretty good about that. I feel like, can I make a 4 or 5% return routinely if there's momentum in the market? That's how I think about it, Sam. Here's my example that I was going to share. So I bought SLB yesterday at it was down almost, I want to say like 1.9%. I don't remember exactly. I bought it at right about that price, I would say. But I didn't want to take any chances today. I didn't know what the market would do. I sold my hedge. I thought it's probably not going to be down big again today, just because it's not typically how the market works, that mean reverts. But I only set my stop down about 20 basis points. I just didn't want to lose any money because I didn't know what was going to happen. And I believe you may disagree. I believe that the machines that buy those orders, if I've got a limit, I have a limit order, my broker has made that available to somebody to execute. And I think they can see those. And I'm only like 8 cents below that price. And so it took me right through my stop, and I got stopped out. And then now it's up exactly as I expected, right? I fully expected it would give me a 1% return, and it did almost immediately. So those are the risks. And I don't like what's happened in the pre-market. It is, were it up to me, there would be no pre-market, because I don't think it's fair, and I think it's distorting, and there are different rules. But be very careful about that, Sam. And then, if you're going to set a stop and you don't want to take any risk, there's a chance you'll get stopped out, because a machine will know, well, that's only 10 cents away. I might as well just run the price through it. And they can do that. If you're 50 basis points down, probably not going to happen to you. That's more risk than a machine assessing all of the, order books. You say, they can't see that. Well, I can't prove it, but the only way that you can handle limit orders is you take everybody's limit orders, and you're going to know, if your retail order flow is being sold. I'm happy to explain that if it doesn't make sense. So back to these entry and exit points. I mathematically, returning to Oracle, it's a very, there's 1.6% of intraday volatility. And if it's down 90 basis points, there's a very high probability, even today, that you can make 80 basis points. And maybe that's enough in this kind of environment. I think when you have a supply-demand equation that looks like this, where it's not bad. I mean, this demand is still way above that 5 point, let's call it 3, 4 average. We know there's excess demand, but it's coming down. Supply is way above trend. It's not bad. It's at 49.3. That's very much in keeping with the averages that we have seen for 200 days, right around 49% in the broad market. That's not terrible. It doesn't say that the market's about to fall apart, but it tells me the probability that things move more. Machines are going to know the same stuff we know, that there's less reliability and that I have less confidence that there's excess demand. So as a machine algorithms run by Virtu or Citadel, they're going to shrink their exposure to the market too. That means that your return on volatility will come down a little bit. Okay, well, take 80 basis points. If you get 80 basis points every day, and I can't, I'm not doing it every day, but you can do it if you're, use volatility to your advantage, but you might want to just take 80 basis points or 70 instead of 1 or 2 or 3%. That's the difference. There are different conditions, and the supply demand balances are going to tell you that. Okay. That is the poll.
Tim, quick question from Pamela regarding how much a stock needs to fall. Do you use the closing price for volatility, or do you use the opening price on a given trading day?
I'm using the difference from the closing price. Opening price is part of volatility. There's no question. What we're calculating is we're taking when we capture that data, we take all the trades that occur in that, whatever it is, 12-hour period that separates one from the next. We take all of them, including the outside aftermarket hours trades. But that's how we think about it. So, is it perfect? No. But I think if you studied the data, you would find there would be very little statistical difference from one point to another. So I think closing price and where is it now is a very reliable read to give you an entry point. And it works time upon time. Not every time. I think I mentioned this the last time I got stopped out of Aramark 3 times. I went one too far, and then I threw in the towel. But the supply demand equation said that should have worked, and it should have, but it didn't. Why? Well, I did it during earnings, not theirs, but in general, and it reduced the likelihood. But that was a real outlier. Generally, I am producing returns doing this. Sam, how would you use the Oracle example with options? Yeah, is capital intent. I gotcha. Buying 100 shares of Oracle is a lot of money. So the same principle applies. The derivative will reflect the movement of the underlying asset. Maybe not. It's not perfectly correlated. And you guys here who are veterans, you can offer who are experts at options. You can tell me, but the same principle applies. If Oracle's down a lot of its volatility, it gives you a good opportunity to buy. Brian's pretty good at this, to buy call options. And if the math works, there's a high probability. Again, there's risk tomorrow because of this jobs number, which could be important. There's a high probability that today or tomorrow you get some movement, and the option should reflect that to some significant factor and take your gains. That's my view, is the principle applies the same way. Okay. That's pretty much what I've got. We can talk about what may come next. Here's what I watch. I'm watching the number. They're not correlated, and Dan Eisenberg, you've pointed this out. There's not high correlation between what the market does and these components in the momentum and low volatility portfolios. But I think when those numbers shrink, clearly math is just searching for opportunities that meet criteria. And as those opportunities diminish, my willingness to take risk diminishes with it. I'm going to be more careful. So there's one thing to watch. And then broad market sentiment, I'm watching in particular this trend. Right now it doesn't give, if this suddenly ticked up above 50, I would be very concerned. I would think, okay, now the market could really take a dip lower. And there's no indication at this point to me in the data that that's going to happen. But there's certainly indication to me that it should decline, at which it's doing. People are reweighting. Big tech, is it terrible? No, but this effect is bearing out in the market. There's significant drop in demand. Supply is fine, but that's what we're experiencing now. It's starting to recover, so it may not tip the market over. I don't know. I think it's a big deal. It's a big deal. Okay. Anything else?
Tim, one other question from Sam. When we have something like the Fitch downgrade yesterday, does that invalidate the signals of the day? Do you wait for the market to digest that news for a day or two?
Not outside of broad sentiment, Sam. Here's what I could I prove it? It's counterfactual, so I can't. If we'd had this kind of demand and supply relationship divergence and Fitch downgraded the debt, I think that we would have a down day and we'd be right off to the races again. So here, with demand waning and supply well above trend, that to me is a bigger matter than anything else. And we see it play out in corporate earnings all the time. We're doing this, looking at no matter what you report, what the news is, if there's a supply demand imbalance, that is more significant than the news. So do I wait? No, I think sometimes it creates opportunities, right? I bought CVX, is that right? I bought the railgun. I don't just keep it straight. That's producing a pretty good return today. So no, it doesn't cause me to change what I think about the data. So that's my thinking on it. Now, when it happened before 2011, the major measures went down for 3 solid months and didn't recover again until December. I think that was a much more dire state of affairs for the euro versus the dollar than what we have today. So I don't know what's going to happen this time, but it's good to know what happened historically. Okay, you guys, that's all I got for today. More next week. Look forward to it. We'll see. We'll come through this jobs report tomorrow and see where we are. Have a good weekend.